Hey guys, hope you're doing well. Another day of math class here, and it's time to learn about how to make you a millionaire. And but first, let's go over this rule of 72 question that you guys did, and most of you did not do right. But that's okay. I'm going to explain it here. So you got 6% return every year. How many years will it take to double? So most of you did this right. Take 72 divided by 6, 12 years to double. Okay, so your money will take 12 years to double. All right, so if you invest 5,000 initially, how many times would it double in 36 years? Okay. Well, this is not the percentage. Okay, you're not getting 36% per year. All right. Um, the times that it will double. Now remember, it takes 12 years to double. All right, how many times will it double in 36 years? All right, well, how many 12s are in 36 years? 3. So it's going to double 3 times in 36 years. You don't want to take 36 into 72 because it's not 36%. Okay, remember, you're dividing the percentage into 72. Um, okay, so I mean, you would, if you wanted your money to double, okay, in 36 years, you could figure out you would need 72 divided by 36. You would need 2% to double in 36 years. But if you have 36 years and it doubles every 12 years, that means it will double 3 times. 3 times it doubles, okay? And so what would be the value in 36 years? Well, you can't just do 5,000 times 3, okay? Because it doubles every 12 years. So it's 5,000 times 2 for the first doubling, okay? This is the first 12 years. First 12 years, all right? Then you would do 10,000 times 2, which is 20,000, which is the second 12, all right? And then 20,000 times 2, which is 40,000. So this was what it would be at after 36 years, okay? So you would have $40,000 at the end of 36 years. So that is, in essence, why your money can grow so rapidly, okay? It's not just multiplying, it's actually multiplying what has been multiplied already, so it grows a lot faster. Okay, so today we're going to talk about asset allocation, which is very important. I'm not going to give you any real strategies of asset allocation today. We're going to do that in another lesson. But first, what is asset allocation? Okay, it is the percentage split up of your money between different asset classes. So percentage cash, percentage bonds, percentage stocks. Okay. Cash is usually in a money market account or a savings account. Okay. Before we get to that, let's jump back. Before we get to talking about asset allocation further, let's jump back and talk about different classes you could put your money in. Okay, from least risk to most risk. Okay, some of you guys didn't really read, I don't think, the sheet that I posted about how money market accounts were the least risk. Money market accounts are basically like savings accounts, all right? The only difference is it's a different name because it's offered oftentimes by a not by a bank, but by a different financial institution, all right? Government bonds, not too risky because the government is strong and healthy. Corporate bonds, more risky. Corporations, could collapse potentially. Mutual funds, you have a collection of partial ownership in companies, so that is a little bit more risky. And by far the most risky thing here is individual stocks. Okay. If you had to ask where real estate would fall, and that would probably be somewhere in, mutual fund, the individual stocks type area, more risky, but not quite as risky as individual stocks and companies, I don't think. If you have because real estate never completely loses its value. Okay, so just keep this in mind. as we talk about asset allocations. All right. So it's how you're splitting up your money into these different categories. These are the answers that you guys put when I asked you what would be your asset allocation. Okay. Someone said 401k because it isn't near as risky as single stocks would be. And yes, 401k plans most oftentimes do not have individual stocks in them, so they're not as risky. But that is not an asset allocation because you're not telling me how you're putting your money in your 401k. You could put your money in many different ways into your 401k. Sometimes they let you pick. Okay, most oftentimes they do give you some options. All right. So retirement plan is not an allocation. A 401k is a type of retirement plan. Okay, you only get a 401k if you work for a for-profit company. Nonprofits get 503bs, and then you have individual retirement accounts called IRAs. And then the one that I like better, the Roth IRA, you don't have to pay taxes on after your money grows for many, many, many years. All right. Somebody said money market account is my asset allocation. Someone said my health care. Okay. Neither of these are asset allocations. Okay. And if you put all your money in a money market account, I guess that is an asset allocation, 100% cash. But that is, maybe a good asset allocation for you currently. But we're talking about like when you get to be an adult, okay? Not like right now. And even now, you should start thinking about actually having a retirement. And I'll talk to you about that in a second. It has to do with the rule of 72. You want your money to double many, many, many times. And if you start later, it doesn't double as much. Okay, and I will invest 65% of my wealth in mutual funds and 35% in bonds. Okay, that is an asset allocation. My only question is, you say mutual funds. Well, are you talking about all stock mutual funds? Okay, and 35% in bonds. That is good. All right, so, and the last one, working and putting money in stocks and bonds. Okay, that's a good plan, but asset allocation, we're talking about how much stocks, how much bonds, a certain number. Am I talking 50-50? Did you look at my portfolio allocation models where it splits up and shows you the returns? Okay, this is what I posted yesterday. This is, what I was hoping you guys would say, which one would I choose here? All right. And so the one person picked 65-35, which is actually kind of a cross between these two here. So that was probably the actual only one that is a real asset allocation. Everybody else is, kind of not there yet. All right. So even though we had all that big chart there, it's important to remember that everything in the past is not indicative of how things will work in the future. All right. So if your allocation was, say, 100% bonds, you would get on average 5.3% return. Okay. Now, that is no guarantee. Okay. That by any means, you could get a lot less than that. Most analysts won't say you'll get much more than that, but it's a possibility. All right. All right. Now let's compare, somebody that's thinking like maybe, I don't want to be too risky. I'll go 50% stocks, 50% bonds. And so that has about an 8.2% annual return. And then somebody might be thinking, I'm just going to go all stocks. Okay. And so there's a difference between the annual returns of about 10.1. There's a 1.9% difference, okay, between 100% stocks and 50% stocks. So that's like a huge difference in allocation percentage there. Okay, but you only get a 1.9% difference APY. And the key thing is APY. APY is annual percentage, okay? So does that actually, is that 1.9%, does that actually affect things over the long haul? Well, I'm glad you asked, because let's look and see if it does. Before we actually do, I want to make sure you guys understand that when I say 100% stocks here, this is the stock market, as in a mutual fund that's 100% stocks. This is not just, 100% of a stock or one or two stocks, which is high risk. This is 100% stock mutual funds, okay? And when you have 100% stock mutual funds, well, the worst you could do is 1931, where it lost 43.1%, or quite possibly this year. But right now, the stock market has lost about maybe 30%, okay? Maybe 20%. It did have a little bounce there. So let's see if the difference between 50-50 and 100% stocks matters. All right, let's go from age 22 to age 67, investing $200 a month into a retirement account, okay? So consistent $200 contributions, that's 45 years until you retire. And guess what? This is how you could become a millionaire. Follow this simple recipe, and you might become a millionaire if 8.2% APY holds true. Okay, you will end up with $1,022,000 odd dollars, okay? And all you would have to do is put in $108,000 worth of money, and that would actually grow to over $1 million, which is pretty remarkable. 100,000 could turn into $1 million. All right, but that is what compound interest does, and that's why you want to be in the stock market and have, maybe some bond exposure. All right, but you can't just sit in the money market because your money will be about the same as when you started. Now let's see. What if we went 100% stock? Same parameters, only 100% stock. Okay, now you have almost $2 million. Okay, so that's over an $800,000 increase over being 50% asset allocation in stocks and 50% in bonds. So it's almost double. Okay. And so you might think the 2%, 1.9% difference between the two doesn't matter, but it's almost $1 million mistake. So it's really important when you're younger not to be afraid of the stock market and be, more risky in embracing, I'm not saying go 100% stocks by any means, but 50-50 is too conservative, in my opinion, at your age. Okay, so there is no good or bad allocations. Okay, you need to find, what is best for you. So a couple factors you should consider is your risk tolerance. Okay, if you are 100% in the stock market, in mutual funds, you could lose 50% of its value in a particular year. Okay, that's why you're investing for the long term and not for the short term. We're talking about, 5 to 10 year horizon at minimum. Your age, you want to be less risky as you get closer to retirement. You don't want to be 100% in stocks right before you retire. That would be nutso. Okay, because you could just lose half of your money right then. Your financial situation, if you have lots of money, you don't need to take as much risk. If you're poor, you need to have more risk to kind of, make up for the money that you are not making. But at the same time, maybe you don't want to take more risk because you need that money for, emergency situations. That's why you should have an emergency fund before you plan on investing in the stock market for retirement. Okay? But this is all, planning out for your future, guys. If you wait till you're my age to start saving for your retirement, you're going to miss out on maybe 1 or 2 times your money would double, which is pretty sad because that would take $2 million and cut it drastically down to like $500,000. And then you'd be, up a creek for your retirement there. So there's a cool little questionnaire to see what asset allocation is right for you. I'm going to ask you guys to do that. And next time, in the next video, we're going to give you a strategy to kind of balance your age and your risk. Okay, so a strategy that you could use and a strategy they used to use, and we'll talk about why it might not be so good to use anymore. But anyhow, thanks for listening. Hope you learned something from this video. Don't be scared of the coronavirus. Trust God. And don't be scared of the stock market as well. And have a good day. Bye-bye.